Welcome to PACE Moments. Here, our experts and guests discuss many aspects of corporate finance and analytical models that will help make better, more informed business decisions possible in your organization.
I'm Doug Hicks, one of the directors of PACE. In this edition of PACE Moments, I'm going to talk about expenses that should and should not be included when measuring product, service, and customer profitability. It's important to distinguish between measurements made from the financial accounting perspective and those made from the managerial accounting perspective. Periodicity is important in financial accounting. Expenses are measurements of the resources consumed during a specific period of time using measurable and auditable historical information in compliance with man-made rules and regulations. Managerial accounting, on the other hand, is more concerned with the long-term sustainable economics of an organization. Expenses are measurements of the resources that need to be consumed for the organization to sustain its business over the long term, whether or not those resources are consumed during a specific period of time or not. In measuring product, service, and customer profitability, the rates used to assign costs to those products, services, and customers should be established at the company's long-term sustainable volume and mix of business, or what is often referred to as its normal level of operations. For example, if an organization is structured to produce 100,000 units of product per year, its rates for measuring product and customer profitability should be established at that volume. If volume falls by 10,000 units without a corresponding downsizing of the company structure, the remaining 90,000 units do not become any less profitable than they were before. Each unit's profitability is the same. You don't blame the product sold for the fact that there weren't enough of them. On the other hand, if volume increases by 10,000 units without a corresponding upsizing of the company structure, the base 100,000 units don't become more profitable. You don't give the base products credit for the fact that there are more of them. If you change the fundamental structure of the organization to produce 110,000 or 90,000 parts, you can modify the rates, but only if you change the structure. And establishing those product, service, and customer cost rates at the long-term sustainable volume of business, all of the expenses, and only the expenses, required to sustain the organization at that level should be included in the calculation. The expenses required to sustain an organization are funded by passing them along in prices of products and services sold to customers. The expenses required to grow the business or make up for failure to sustain a business in the past are funded by the profits earned on products or services sold to customers. That means for managerial accounting, some of the expenses recorded in financial accounting are actually investments, and some of the amounts not spent during a financial accounting period are still expenses. Consider 4 types of typical expenses: research and development, product or service development, marketing, and employee development. In a growing organization, a portion of these expenses will be incurred to sustain the business at its current level. Those are rightly includable as expenses in measuring product, service, and customer cost. Some of those expenses will be incurred to support the future growth of the organization. For managerial accounting purposes, these are investments and should not be included in those costs. Similarly, any amount spent to catch up for failure to spend enough in these areas in the past should be excluded. Both the investments and amounts spent to redress past spending shortfalls are funded by the profits earned on products and services, not as part of the expenses passed along to the customer in the price. If, on the other hand, a company is not spending a sufficient amount in these areas or certain other areas like maintenance to sustain the organization, the expenditures required to sustain the business remain expenses, and they impact product, service, and customer profitability, even if the funds are not spent. A product, service, or customer is not more profitable because the company is not spending enough to sustain the business. To sum up, customer, product, and service profitability should be measured using rates established at the long-term sustainable volume and mix of business at which the organization is structured to operate. All of the expenses and only expenses required to sustain the organization at its existing practical capacity should be included in the calculation. That means that some of the expenses recorded in financial accounting should be treated as investments, and some amounts not spent during a financial accounting period still included as expenses. That's my point of view. What's yours? Let us know by posting your comments in the PACE website's forum. We love to hear from you. Thank you, and I hope to talk to you again soon.
Thank you for listening to our PACE Moments podcast. To learn more about profitability analytics, check out the PACE website, join one of PACE's interest groups, and follow PACE on LinkedIn and Twitter. Thank you.